Every transformative technology company, from Apple to Airbnb, was once a small team with an idea and a need for capital. Venture capital is the engine that powers the most ambitious startups, from early concept to global scale. In this video, we break down exactly how that process works, round by round. Venture capital is a form of private equity financing where investors provide capital to startups and early-stage companies in exchange for an ownership stake. Unlike a bank loan, there's no obligation to repay the investment if the company fails. Venture capitalists accept that risk because the potential upside, owning a piece of the next billion-dollar company, is enormous. Venture capital operates at a scale most people don't appreciate. In 2023 alone, venture investors deployed over $285 billion globally. Yet despite that volume, fewer than 1 in 2,000 startups ever receives institutional venture funding. This selective deployment is by design, as VCs are hunting for the rare company capable of returning their entire fund on a single investment. Before any formal venture round, most founders go through what is called the pre-seed stage. This is the earliest capital, often from friends, family, or individual angel investors, used to prove that the idea is worth pursuing. The deliverable at this stage is typically a minimum viable product, something concrete enough to take to institutional investors in a subsequent round. The seed round is the first formal institutional financing event. A company at this stage typically has a working product and some early evidence of demand, but has not yet achieved the consistent growth metrics required for a Series A. Seed investors are betting on the founding team's ability to discover a scalable business model before the capital runs out. Series A is the round where a startup must demonstrate that it has found product-market fit, that real customers reliably pay for what the company sells. The capital raised here funds the transition from searching for a business model to executing one. At this stage, institutional investors apply rigorous financial analysis, and valuations are set based on growth trajectory and addressable market size. Series B and C are growth rounds, not discovery rounds. By the time a company raises a Series B, the business model is validated and the objective is scale. Series B capital typically funds aggressive customer acquisition, team expansion, and geographic growth. Series C, often the last private round, prepares the company for either an acquisition or a public market offering. Each funding stage represents a significant jump in capital deployed. The median Series A round is roughly 5 times the size of the median seed round, reflecting the greater certainty the investor has about the business model. As a company progresses through later rounds, valuations increase substantially, but so does investor scrutiny and the pressure to deliver consistent financial performance. Venture investors evaluate every potential deal through a consistent framework. The founding team is often weighted above all else, because a great team can pivot a mediocre idea into a great business. Market size matters because even a dominant position in a small market will not generate the returns a VC fund requires. Traction, hard data on growth, is the evidence that connects team and market to financial reality. Every time a startup raises a new round, it issues new shares to investors, which reduces the ownership percentage of every existing shareholder, a process called dilution. While this can feel like losing control, the trade-off is that each round ideally increases the value per share enough to make every shareholder better off in absolute terms. Understanding dilution is essential to evaluating whether any given round creates or destroys founder value. The term sheet is a non-binding document that outlines the key financial and governance terms of a funding round before the full legal agreements are drafted. 3 terms deserve particular attention. The pre-money valuation determines the price per share. Liquidation preferences protect investors in a downside scenario. And pro rata rights allow investors to maintain their ownership percentage in future rounds. Venture capital math is counterintuitive. A fund does not need every investment to succeed, it needs one or two extraordinary outcomes. The Power Law describes how returns in VC are distributed. The top investment in a fund often outperforms the rest of the portfolio combined. This is why VCs accept the high probability of individual failure. They're optimizing for outlier performance, not batting average. Every venture investment ultimately needs an exit, a liquidity event that converts equity ownership into cash returns for investors. The two primary paths are an initial public offering, where the company lists on a stock exchange, or an acquisition by a larger corporation. Acquisitions are by far the more common outcome, and the structure of any exit determines how proceeds are distributed among the various shareholder classes. Venture capital is, at its core, a structured bet on human ingenuity. The funding rounds described here, pre-seed through growth equity, are the checkpoints by which investors evaluate whether a company deserves more capital to pursue its vision. For founders, understanding this system is not optional. It is the financial language of the startup ecosystem.